Okay, let's get into it. They're saying here, the financial information relate to DBN Limited. The company sells household products. The financial year ended 29 February 2024. Right, they giving us what the financial year end, and they saying it is 29 February 2024. I was asking a question over to when is it starting if it ends on the 29th of February 2024. I think we need to work on that first. When is it gonna start?
The 1st of March 2023.
1 March 2023. Thank you on that. And then it ends on the 29 February 2024. Okay, so this is our accounting period. It started on 1 March and then it ends on the 29th of February. Okay, that's good. And then now let's go back to the question then. They saying here required, the bookkeeper has recorded with, they saying here refer to information number A, which means now for us to answer 1.1, we just need to refer to information number A. There's nothing much that we will need to do, but we need to refer to the information number A, then we will be able to answer question 1.1. The bookkeeper has recorded all entries regarding the fixed assets in the books. Complete the amounts denoted by Roman figure 1 to Roman figure 3 on the fixed asset note. So that's the only thing that we need to do for 1.1, and we're going to refer to information number A. Then 1.2, we're going to refer to information C and D. They're saying here, calculate the correct net profit after tax for the year ended 29 February 2024. Indicate plus for increase or minus for decrease next to each amount. And then they're saying complete the statement of financial position on 29 February 2024. Okay, so this is what I'm more interested on, which is the statement of financial position or the balance sheet. That's what we're going to do. This question 1.2, where we have to calculate the correct net profit after tax, we did work on it. We're just going to go through the transaction and just remind ourselves with how did we calculate the amounts that we have here. Okay, then let's go to information number A. We're going to go through information number A and then we start answering 1.1. Information number A, we have a fixed assets note here. We can see we have buildings, we have vehicles, and we have equipment, which is 3 fixed assets that are part of property, plant, and equipment. Okay, carrying value. They gave us the carrying value. Let's not worry about the grayed out cells. We don't have to worry about these ones, but we need a cost for buildings. That is the first thing that we need. Number 2, we need the depreciation for vehicles, which means we need to calculate the depreciation for vehicles. And then we need disposal and carrying value for equipment, which means for all the equipments that were disposed, we need to do what? We need to calculate their carrying value for equipment that was disposed. And then they're saying here depreciation is calculated as follows. Vehicles is 15% per annum on cost, equipment, that is 20% on diminishing balance method. And then we have a new vehicle that was purchased, was bought on 1 October 2023, which means when we're starting to calculate depreciation for vehicles, we need to consider this. And then they're saying extracts from the fixed asset register in respect of the equipment sold. We did speak about the fixed asset register before. We stated that that is a document that records all the assets that the company has, which it records particularly the asset number or the asset code. There must be an asset code there. There must be a description of the asset. There must be the date when the asset was purchased. There must be the useful life. There must be the cost price, the depreciation, the accumulated depreciation, and the carrying value should be there. Those are all details that should be there. As you can see here, This is just an extract, which means we took one asset in that fixed asset register or one line item, which is an equipment. Here we have Kinopa Mwalimu 234. This is a type of like an equipment that we have, and then the cost price was 80,000, which means when we were buying this equipment, we purchased it at 80,000 rand, and then it was purchased on 1 September 2021. When did we sell it? We sold it on 31 May 2023. We sold it for 53,000 rands, and then they gave us what? 20 February 2022. This is what the carrying value at the end of its first year. And then 28 February 2023, this is the carrying value at the end of its second year. Now we need to calculate the carrying value on the date of disposal. So this is the information provided to us, guys. We're going to start with Roman figure 1, which is the cost price for buildings, right? I'll just say here, this information is under 1.1. So we're going to do 1.1 here, and then I'm just going to have okay, let me just do this. I don't know why is it not showing. Okay, we have 1.1 here, and then I'm just going to show the Roman figure 1, which is the one that we're going to work on, and then we see after that. So for Roman figure 1, what we're calculating, we are going to calculate the cost price for the building, right? We're going to do the cost price for what? For the buildings. How are we going to do that one? Looking at the information that is provided here, looking at this fixed asset note, we have the cost at the beginning here. We don't have the cost at the beginning, but we can see that there was land and buildings that were disposed. We have those buildings that were disposed, and then we have a carrying value at the end, if you can see here, which means now we know very well that we did not buy anything, and also there's no depreciation that is indicated here. So for us to calculate that Roman figure 1, I know that the cost at the beginning, that we're going to have 0 accumulated depreciation, and then it will be the same as the cost as the carrying value at the beginning. And then carrying value at the beginning minus the disposal at carrying value, we're getting the carrying value at the end. So for us to get this cost at the beginning, we just need to work backward, which is going to be the 9,421,300, and then I add back how much? I add back the 420,000. That's simple and straightforward for us to get that cost price. So these are free marks, guys, that we need to collect. Please, I don't want mistake here. I don't want you to leave marks that are very easy for you to obtain. So we're just going to have 9,421,300 rands plus 420,000 rands. That is going to be 9,421,300 rands. And then we're going to have what? Plus. We're going to plus how much? We're going to plus the 420,000. And then how much are we going to get there if we add the two amounts? If you punch your calculator, how much we're getting?
9,841,300.
9,841,300 rands. What is this going to be? This is going to be the cost price at the beginning for buildings, right? Thank you for that. Okay, then now we can move on to Roman figure 2 and see what we're going to have there. Roman figure 2 and see what they want us to calculate. Okay. For Roman figure 2, it's a depreciation for vehicles, right? We need a depreciation for vehicles, okay? We need a depreciation for vehicles. Let's see how we're going to do this one. Let's go back to the information. Here, we do have the carrying value at the beginning for vehicles. We can see that we have a carrying value at the beginning for vehicles. And what else do we have? We have the additions at cost. We know that we purchased a vehicle, which means now for us to calculate our depreciation, we need to start with, and then we have the cost at the end here, which is the total cost of the vehicles that we have at the end. I always say to you guys that because we purchased, they saying here a new vehicle was bought on 1 October 2023. So what does that mean? We need to start calculating a depreciation of a vehicle that is new. If there was a vehicle that was disposed, we're going to start with what was disposed, especially for the equipment, since we know that there is an equipment that was disposed. So which means now I am going to do my depreciation for the vehicle that was disposed first. Those are the things that we should be aware of. Those are the things that we should be aware of. Okay, let us start here. So which one we're going to start with here? We're going to start calculating a depreciation for this vehicle that was purchased. When was it purchased? It was purchased on 1 October 2023, and the depreciation rate is 15% per annum on cost. So my starting point is to calculate a depreciation for a new vehicle. So I'm just going to say here, new, and then how am I going to do the calculation? I need to take my 260,000 that was purchased, right? And then I say multiply by 15%. You guys will guide me. If I'm going wrong, you must tell me. 15% on cost price, I will say 260 minus 15%, which is multiplied by 15%. Do I have to apportion this one? What am I going to do? When did we buy this one? From 1 October 2023. So how many months we going to apportion with?
5/12.
5/12. Please count for us, starting from 1 October.
October, November, December, January, February.
Exactly. That is going to be 5/12. Okay, thank you for that. So which means now I'm just going to say go to my spreadsheet and say multiply by 5/12. Okay. Then how much am I going to get as the depreciation for the new vehicle?
1,625.
1,625, right? You're getting 1,625. 15% of 260.
Sorry, I added
Yes.
a 0.
Okay, how much we getting then?
250. 16,250.
16,250, right?
Yeah.
Thank you for that. Okay, and then now we need to calculate the depreciation for the old vehicle. So let's go back to our information and see what do we have for the old vehicle. So now, what is going to be the cost price for the old vehicle now? Because we need to separate it. So which means since we had a cost at the end of 786,000, which is including this cost price for additions, I need to subtract these additions from 786,000 rand. And then that will be the cost price of the old vehicles. And then I just multiply it by the cost. So which means my starting point will be 786,000 minus 260,000. That is my starting point, right? 786,000 minus the cost price of the new vehicle, which is 260,000. And then what do I do after that? I multiply it by 15%. And I don't have to apportion this one because it is an old vehicle. So how much am I going to get in this situation? How much are we getting here? How much we getting, guys?
78,900.
78,900 rands. Thank you for that. Then now I'm going to get the total, which is 16,250, and then I say plus the 78,900 rands. Okay. Then how much am I getting after that?
95,150.
95,150. Thank you. 95,150. So this is my depreciation for vehicles, which is Roman figure 2. Then now if I go to Roman figure 3, what do they want me to do there? Roman figure 3, we need what? We need a disposal at carrying value for what? For equipment, right? We need a disposal at carrying value for equipment. Okay, disposal at carrying value for equipment. Okay, disposal at carrying value for what? For equipment. Remember what you need to do here. You just need to calculate the carrying value of the asset disposed. That's the only thing. And looking at the information that we have here, we already have the carrying value on the 23rd of January, which means like this is like a carrying value at the beginning. If you look at this, if you look at this one, 57,600, it's like a carrying value at the beginning. So the only thing when you need to do, we just need to calculate the depreciation for the current financial year, and then what we're going to do after that, we subtract it from this 57,600. Then we're getting what? We're getting our carrying value. And remember the depreciation here is calculated. They're saying equipment 20% on the diminishing balance method. So which means my starting point will definitely be the 57,600 rands, because that is a carrying value. I always say cost minus accumulated depreciation, and then I work it on a carrying value. Since they've already provided us with a carrying value, the only thing I need to do here, I just need to multiply it by 20% and decide whether I need to apportion it or not. That's when I will get a depreciation for the current financial year up until the date of disposal. Then after that, what do? I subtract it from this carrying value. I get the new carrying value at a date of disposal. So let's look at it then. So my starting point will be 57,600 multiplied by 20%, because we already have a carrying value there. So how am I going to do it? So here I'm going to have what? Sold. Okay, it's a depreciation, obviously. I can just say how much we have here, 57,600, okay? And then I say multiply by 20%, right? I say multiply by 20%, which is the depreciation rate that is provided here. And then what do I do after that? When did we sell this? On the 31st of May, 2023. That's when this was disposed. They told us here, date sold, 31 May 2023. So how many months am I going to apportion with in this situation?
4 months.
It's going to be 4 months, starting from which month? Let's calculate.
March, April, May, and then you have to count the whole of May, so it goes on to June.
Sorry, please come again.
March, May, but didn't it depreciate for the whole month of May, so you count another month?
It's going to be March, April, May. Do I count June as well?
I'm confused because it's like...
No, we don't count June in this situation. Yeah? We don't count June. If it was disposed at the end of June, I was going to consider June. But this one is only 3 months because my year is starting on the 1st of March. So I'm going to have March, April, May. And I sold it on the 31st of May, as you can see here. I don't go to June. I don't have to go to June because I'm adding. It's like now I dispose it on the 30th of June, which is not the case. This one was just sold on the 31st of May. So my counting will be March, April, May, which is 3/12. Then I just need to say here, multiply by 3/12, right? And then how much am I going to get as my depreciation?
2,880.
Getting 2,880. Thank you for that. And then now, in terms of the carrying value, then how am I going to calculate it? I need to take this 57,600, 57,600, and then I subtract the depreciation, which is 2,880. Then how much would be the carrying value then?
54,720.
That is going to be 54,720. Thank you for that. Okay. I hope you guys are following. These were just free marks that we needed to collect free of charge. How many marks is this? I think this was about 13 marks that we needed to take. Oh, it's just 12 marks. You see, it's something like as a warm-up for you. It has to be a warm-up for you because, guys, I believe now you understand how do we work with a fixed asset note. Very important to understand this thing. Very important to understand the formulas that I showed you, the 3 formulas that I showed you on how to do the fixed asset note. But if you're still not comfortable with it, don't stress. We still have like plenty of time. We're going to work on this thing. We're still going to work on this thing when we're doing cash flow. I'm still going to work on it when we're doing fixed assets separately. So you have to understand this one. Like it's a must that you understand the fixed asset note. Okay. Then now we move on to 1.2. They're saying here, refer to information C and D. They want us to calculate the correct net profit after tax for the year ended 29 February 2024. Indicates plus for increase and minus for decrease next to each amount, right? That's what we need to do. So we did work on this question together, guys, where we needed to refer to information C and D. I don't want us to recalculate this again. I'm just gonna bring what we did. Just gonna bring what we did here. You can see we do have these workings. This will be my 1 point. This will be my 1.2. We did the workings, but since we did them like a while ago, I think I would like us to discuss them a little bit before we can say we move on to the next question. Okay, so here what we needed to do, let's go to information C and D. If we go to information number C and D, firstly, we have information number B here, which is the balance is on 29 February 2024. They gave us fixed assets at carrying value, 9,952,480. Ordinary share capital. Right now, if you look at the question that they provided us here, we are actually now going to do like this one. This is the income statement. 1.2 is the income statement that we need to do here. This is for 1.2. We need to prepare what? The income statement. But when it comes to 1.3, we need to complete the statement of financial position on 29 February 2024, which is now a balance sheet. And I has always been telling you guys, when you do the income statement and balance sheet, you must do them simultaneously, because one transaction is definitely going to affect both of one transaction is going to affect both income statement and the balance sheet. So, and then you need to treat that in that scenario. So that's what I need to apply now. That's what I want us to apply as we're going to start from information number B, and then we're going to look at information number C, and we're going to look at information number D, E, F, G. And then after that, we should be done with our balance sheet after that. So looking at this fixed asset at carrying value, they gave us a carrying value here for fixed assets. We're not sure whether we still need to adjust this or not. So which means now what I need to do, I need to go straight to my balance sheets. There is it here, DBN Limited, balance sheet on 29 February 2024 with assets, non-current assets. And then for my fixed assets, I'm just going to open brackets there and say 9,952,480. Am I right on that? 9,952,480. Why am I doing this? Just in case if I have to subtract something or I need to add something, I don't know. We will see as we carry on with our information. Ordinary share capital, they didn't give us ordinary share capital. Retained income, they didn't give us. Loan, PTA Bank, they didn't give us that. But when it comes to the fixed deposit, we do have how much there? 425,000. So what am I going to do with my my fixed deposit? I need to take it to here. We're having how much? 425,000 rands. Can you see this one? Because these were balances that were provided. We don't know whether we still have to adjust them or not. Trading stock, 1,064,200. We know where it goes. It goes to the balance sheet under inventories. How much do we have? 1,064,200. Okay. 1,064,200. Okay. Then now net trade debtors. Where do these ones go? Since they're saying net trade debtors, it means These are debtors control minus provision for bad debt. Already it has been subtracted. I think I once showed you something like this on the note. I don't know when we did this. Let me just come here. I just want to check something. You see, under trade and other receivable, we have trade debtors, less provision for bad debt. And then we're getting what? We're getting the net trade debtor. So in this situation, they gave us the net, which means already provision for bad debt has already been subtracted. Then what am I going to do? I'm going to start with it for my workings here. On the net trade debtors, I have 744,900, which is, this is part of the note. Since they didn't say we must prepare the note separately, I'm just going to do my workings here. I'm going to squeeze my workings on the balance sheet. 744,900 there. And then creditors control were 518,950. Where does this one go? It goes to my balance sheet under current liabilities, trade and other payables. You can see here, I'm just going to say creditors control 518,950. I'm going to put 518 here, 950. I hope you guys are following this strategy that we need to follow, because you don't want to lose you lose your mind along the way. You don't want to leave some of the amount unaccounted for. SARS income tax, provisional tax payment, you can see this one for now, it is a receivable, right? Because if we talk about provisional payments, which means this is a debit balance, SARS is owing us at the moment. This is a debit balance, SARS is owing us at the moment. We don't know what else that is going to happen. We need to check how much would be the tax for the current financial year so that we can decide. For now, this one, I'll keep it here. I'm not going to record it anywhere, but I'll keep it here because it is a debit balance for now. But along the way, they gave us the information about income tax here. If you look here, the assessment from SARS indicates a total income tax for the financial year as 351,000 after all adjustments has been made. So which means now SARS was owing us 322,800, but how much are we owing SARS? 351. Which one is the bigger one between the two? Are we going to end up having a liability or is it gonna be a liability or still a receivable? 322,800 SARS owes us 322,800. Let me just put it here. 322,800. A provisional payments means that SARS owes us, right? SARS owes us. These are provisional payment. Then tax expense. Obviously, this is what we incurred and we have to pay over to SARS. How much is the tax expense from the information? They told us that it is 351,000 rand. So are we owing SARS at the end, or SARS is owing us in this situation?
We owe SARS.
Definitely, we're going to owe SARS because we incurred more than what we paid. These are provisional tax payment. These were just provisional. What is a provisional tax payment? What is a provisional tax payment? These were payments that were made during the year, right? These are the payments that we made during the year to wait for SARS to charge us so that we know how much SARS is charging us. We found out that SARS charges 351, so we need to add more from what we paid. We only paid 322,000, then the difference needs to be added. So we're owing how much? We owe 28,200. This is going to be a liability. That's why we see on our, by the way, this is the format that you're going to find on your answer sheet. This is the format. It is on the answer sheet. We know that SARS income tax is part of what? SARS income tax is part of trade and other payables. If it's a liability, it's part of notes number 9, but sometimes they will want to put it separately here, as you can see, then which means you're going to show the 28,200 here as part of what? As part of your trade and other payables. So what is my workings going to say? For my workings, I'm going to have 351,000 and then minus 322,800, right? Then I'm getting my 28,200 as what? As my SARS income tax. Okay, let's carry on. It was just a matter of touching on this one. We must know that SARS, the income tax that is sitting here, since here they're not telling us whether it's a debit or credit. Sometimes when the trial balance will show you a debit and a credit column, that's when you'll see, or they'll show positive or negative amounts here. Since they're not saying anything, but this provisional tax payment, it tells us this is a debit balance. SARS is owing us because we paid before time. It's like a prepayment. It's like a prepayment of tax expense. It's like we paid tax before they charged us. That's why now we need to compare what we paid and how much SARS is charging us. Then the difference, we make a decision whether it's a liability or not. Let's go to number C. So which means information number B, we looked at it, we're happy with it, we are okay with it. So we're moving on now to information number C. They're saying here the bookkeeper has calculated the net profit before tax of 1,150,000. The pre-adjustment balances to be adjusted are as follows, right? We have audit fees here. Audit fees, they have to be adjusted. We know about that. Trading stock, it has to be adjusted. Rent income, it has to be adjusted. Directors' fees has to be adjusted. But they're saying here only the adjustment listed below must still be taken into account. So I need to look at these adjustments and see whether I need to adjust them or not. The first one is audit fees of 45,600 were still owing on 29 February 2024. So how do we treat this one? What did we say before the last time?
Accrued expense.
Exactly, it is an accrued expense. So on the income statement, what do we do with it?
We add it onto the audit fees.
We have to add it on the audit fees. So which means now we're going to subtract it on this. We're going to subtract, it's going to be an additional subtraction on what? On that amount, 144. No, on the profit before tax. So which means now if I go to my income statement, of which we've already done that, there is audit fees here, as you guys can see, 45,600 rands. So you can see there's audit. We subtracted it from the 1,150,000 because it was not considered. Because of the fact that this is an outstanding audit fees, right? There is it here, we've considered it here, and then we have subtracted audit fees. Okay, then let's talk about the balance sheet. How is it going to affect the balance sheet?
It would go to trade and other payables.
Exactly. It is gonna go to trade and other payables, then which means now I need to go and say, under trade and other payables, I need to go and add how much here? I need to go and add that 45,600, which is still outstanding. This means that we are owing this 45,600. Okay, that's how our workings are. We're done with the transaction then, because we have covered it in both ways, right? Which means we're done with the transaction. Are we guys happy with it? Are you guys following?
Sir.
Yes.
I'm sorry to disturb you. May I please be excused? I forgot to charge my phone this morning and I'm currently at 2%.
Okay, no problem. Sorry about that. It's fine. I'll load the video on YouTube. You must go and catch up there, right?
Thank you.
All right, no problem. Thanks. Bye. Okay. Kinelwe, you happy with the transaction, how we dealt with it, both income statement and balance sheets, now?
Yeah.
Okay, thanks. Then now let's go to a donation, number 2 now, right? They're saying here a donation of 100 blankets was made to Children's Hospital, but the donation has not been recorded, right? So which means now we took blankets. Blankets is a trading stock for us, that is inventory. We took it and donated to Children's Hospital, right? But the donation has not been recorded. The business uses weighted average method for valuing blankets, that is inventory valuation method. The stock records for blankets reflects the following. We have the quantity, unit price, and total cost. Purchases during the year, we have 1,500 units that were purchased, which is 600 plus 900. And then the total cost is 603,000, which is 198,000 plus 405,000 rands. Sales, stock on hand, 280,000. Then now, what you need to be aware of is that we need to calculate a weighted average method here because we're going to have a donation expense that needs to go to our income statement that was not recorded, but also at the same time, which means our trading stock is overstated in the balance sheet. So we need to go and deduct the value of these blankets. So if we go to our income statement, if we go and check how did we deal with it on the income statement, we did calculate a weighted average price. These are the workings here that we made. We said 603,000 divided by 1,500, and then we got the weighted average price of 402 rands. Then we multiplied that 402 with 100 rands, and then we got 40,200 rands, right? Which means this is a donation expense that was not recorded. Then we came to our income statement, we recorded it there as what? As donation expense, which means we're subtracting it from that incorrect net profit before tax. But when it comes to the trading stock, to the balance sheet, how are we going to treat this on our balance sheet? How did we say we're going to treat it on the balance sheet?
So can you go back to the workings?
Okay, yes.
Would you add it into inventories? I mean, subtract it from inventories.
Definitely, we have to subtract it from the inventory because it was not recorded. Let's go back to the transaction again. They said here a donation of 100 blankets was made to the children's hospital, but the donation has not been recorded, which means now we did not record the expense, we did not record the inventory part of it, because the journal entry that we needed to process here in this situation, we needed to debit what? We needed to say debit donation expense, right? Debit donation expense, and then what we're going to credit what? Inventory or trading stock. This transaction was not recorded. When you debit donation expense, you're increasing your expense. When you credit inventory, you're decreasing your asset, your inventory. So that 40,200 should be added as part of expenses as we did there, but at the same time, it should be subtracted on the inventory. So I need to come here and say minus 40,200. Are you following?
Yeah.
Okay, perfect. Now let's carry on to number 3. The issue with number 3, they said rent was increased by 1,300 per month from 1 January 2024, right? Which means 1 January 2024, that's when the rent was increased. Only the rent for the period 1 March 2023 to 31 January 2024 was received and recorded. So which means now, is this an accrued income or income received in advance?
Income received in advance.
Why are we saying that?
Because they can claim the money back and never provide
but we received it. Sorry to cut you, Kenelwe. We received it up until March. You can see here up until, no, sorry, we received it up until January. Is this accrued or paid in advance? When is our year ending? Received in advance?
Oh, wait.
Yes.
Does it ends February?
So which means there's rent that we didn't receive, no?
Yeah. So it's accrued income, yeah.
Exactly. Very good on that. It is going to be an accrued income. And we did the calculation already for rent. I think we did work on it. I'm not sure it was how much. I think it was, there's it here. You remember it was 26 how much we got? 26,000, I don't know. I don't remember. If we look here, rent income, it was 26,000 plus 1,300 that was outstanding. In total, it is 27,300 rand. So what do we do with this 27,300 rand? We added it in the income statement because it was outstanding. It is an income that was not received, right? We added it in the income statement because it was an accrued income. Then now we go to the balance sheet. On the balance sheet, it is going to be an accrued income, which means under receivables, it has to be added there. And how much do we need to add as part of this? It is going to be 27,300 because it has to be the same as the amount that we added in the income statement. 27,300 must be added in the receivables as well. 27,300 rands. Okay. Are you following?
Yes.
Perfect. Now let's go to number 5. Number 5, what they saying here. Number 4, sorry. The company had one director, Jenny. We don't have to worry that much about calculations now because we did these calculations before. The only thing I want you to tell me is whether we have an accrued expense or prepaid expense, whether it's going to be an expense. Yes, it's going to be an expense. But when it comes to balance sheet, is it a liability or a receivable? That's all I want to know with these transactions because we worked on them already before. The company had one director, Jenny, at the beginning of the financial year. Jenny had been paid in advance, or they told us here, for 2 months. A second director, Frank, was appointed on 1 December 2023. His monthly fee is 20% lower than that of Jenny. Frank received fees due to him. Since here we have directors' fees that were paid in advance, how do we treat that in the income statement? We did the calculation. It was done. I think these are the calculations that we did, and we found out that how much was paid in advance. It was 104,000 rands in total, the amount that was paid in advance. Since it is the amount that was paid in advance, we coming here to say we adding it back because we subtracted more here. We subtracted even the amount that was not supposed to be subtracted. Then now we're canceling it by adding it back. That's why we can see here we have 104,000 rands. Okay. So which means this was this 104,000 rands. We can see that these are directors' fees that were paid in advance. So we dealt with it in the income statement by adding back that 104,000. But when it comes to the balance sheet, is it gonna be a liability or a receivable?
A receivable.
Definitely it's going to be a receivable because it is something that was received in advance. So which means now I'll carry on here and say plus 104,000. Okay. I'll carry on here and say plus 104,000 rands, which is the same as the amount that we calculated there. Okay. Yes, 104,000 rands. Okay. Then we carry on. Then we carry on income tax. We have dealt with this one already. 351,000. Okay, we knew that we had to subtract it here, and then income tax expense 351, and then we got 844 as the net profit after tax. I'm not too interested in this one because it's something that we worked on it before. But now I just want us to carry on with the rest of the transactions. Number D, we dealt with number D. We recorded it in the balance sheet, and also in that short income statement, it was recorded there. Then now we need to go to number E. Number E, looking at this one, share capital and dividends. They're telling us about share capital and dividends here. 1 March 2023, we have how much? 2,120 shares that were in issue. This was at the beginning. These are the shares that were in issue at the beginning. Then 30 June 2023, we have 230,000 shares repurchased. The average share price was R5.90 at the date of the repurchase. This was the average. This was the average price, R5.90. Then now, 29 February 2024, we have 1,890,000 shares in issue. We can see that these are the shares that were issued at the end. Okay, then they're saying interim dividends were not declared during the financial year. We know that we have no interim dividends, which is good. Final dividends of 25 cents per share were declared on 29 February 2024 to all shares in the share register. So which means now I want us to talk about the dividends first. The shareholders for dividends, you must remember that shareholders for dividends is the same thing as final dividends, right? Final dividends is the same thing as what? As shareholders for dividends. We can see that in our balance sheet, we do have shareholders for dividends as part of our liability. And we know how to calculate that, our final dividends. They gave us here that it is 25 cents per share were declared on 29 February 2024. And how many shares on 29 February 2024? We can see that we have 1,890,000 shares. So which means now I can say 1,890,000 times 25 cents. And then how much am I going to get as what? As my shareholders for dividends? 1,890,000 rands multiplied by 25 cents. So how much am I going to get, which is going to be my shareholders for dividends?
472,500.
We're getting 472,500 rands. Okay, 472,500 rands. Okay, so this is our shareholders for dividends. At the moment, looking at the information that we have here for share capital, ordinary share capital, this was shares issued at the beginning. We're not interested in those ones that much. And then on the 30th of June 2023, 230,000 shares repurchased. The average share price was 590 at the date of repurchase. And then 29 February 2024, 1,890,000 shares in issue. We must know, Kinielo, that the shares that were issued at the end, mostly they are issued at the average share price. The average share price was 590. That's the amount that will help us to get the ordinary share capital at the end, because they don't usually give you, they will not definitely give us that 1,890,000 shares were issued at how much. But we know that at an average price, that is the price that shares were issued at. And looking at that balances that were provided there, they didn't give us ordinary share capital. So which means now for me to calculate my ordinary share capital at the end, I can take 1,890,000 multiplied by the 590. How much am I going to get for my ordinary share capital? 1,890,000 times 5 rand 90, and then how much am I going to get?
11 million. Wait.
Yes, come again.
Yeah, 11,151,000.
151,000 rands. Okay, 11,151,000 rands. So this is our ordinary share capital that we have. But now when it comes to the retained income, because now the next thing to get here is the retained income. But can we get a retained income in this situation? Remember, on the retained income, we need a net profit after tax, of which we already have that. And then the share buyback here is considered. Hello, can you hear me?
Yeah.
I'm sorry, I think my network, I don't know what was happening with my network. I'm sorry about that. Okay, I was saying that for retained income, where
Where are you?
now Hello, can you hear me?
Hello?
Yes, can you hear me on your side?
Yeah.
Okay. We said also what else we need. We needed that difference that we spoke about for share buyback, because I did say that share buyback also affects retained incomes. You'll remember our previous session. There is something that we spoke about retained income being affected by the ordinary share capital, the share buyback, but that should be an extra amount that we don't have here. So which means it won't be possible for us to calculate retained income from the information that is provided here because of this amount of share buyback that we don't have, right? They only gave us the average share price, but we don't know at how much did we buy back the shares, which is going to be impossible for us to calculate that. And as a result of that, we're just going to move on with our information. We're just going to move on with our information. And then we go to information number F. What they're saying here, they're saying a debtor with a debit balance of 8,400 rand in the debtor's ledger must still be transferred to his account in the creditor's ledger. This one is very trick, this situation here. If you look, when you transfer debtor from debtor's control, which means I'm going to debit my debtors, and then what am I going to credit? I'm going to credit my debtors, and then I need to debit my account. My accounts payable or my trade and other payables. So I'm crediting trade and other receivables and debiting trade and other payables, which means now, let me read this transaction again. A debtor with a debit balance of 8,400 in the debtor's ledger must still be transferred to his account in the creditor's ledger. You see, we're transferring something from debtor's ledger to creditor's ledger, which is going to be which means this debtor's balance is going to decrease debtor's balance, and it is going to decrease the creditor's balance, because the journal entry that I'm going to process in this situation, it is going to be something like debit. I'm going to debit my trade and other payables, and then what am I going to credit? I'm going to credit my trade and other receivables, because I'm transferring it from this side to the other side. Then in this situation, which means now my payables are decreasing and my debtors are decreasing, because payables, the liability, decrease on the debit side. As you can see here, it is debited. Trade and other receivable, that is an asset, and it decreases on the credit side. As you can see here, it is credited. So these 8,400 that we can see in this transaction will end up being subtracted in both trade and other receivable as 8,400, and trade and other payables will also be subtracted there as 8,400 rands. Are you following this one? Are you following this one, why we have to subtract it in both sides? Hello,
Yes.
Okay. Please, you must understand what is happening here, because it is something that is going to be, the transaction like this can be very tricky. It is that transaction that is trying to deny you to get 100% in the exam, because they want to trick you with this one. It is a very practical scenario. When you're transferring from debtor's control to creditor's control, you must know that it is going to be a 0-0. Actually, this transaction, it's like it has no effect, because you subtract something this side and you're subtracting it on the other side. Loan. Now let's deal with the loan. Loan account, they're saying here, extract from the loan statement from PTA Bank. Balance on 1 March 2023 is 1,400,000 rands. And then repayments for the financial year, they didn't give us the repayments interest capitalized. They gave us what? They gave us the interest expense. And then balance on 29 February 2024, they gave us the balance at the end of the year. which is 1,004,000. I know very well this under loan, I'm going to have that 1,004,000 rands, but I need to subtract what? I need to subtract my current portion of loan, which still needs to be calculated here. So how do we deal with a loan transaction? I always encourage you to do what? To do a T account. So let's do that and see if we can be successful in terms of doing a T account for us to deal with this loan. I'm just gonna see where am I going to do my workings here. Let me just do my workings somewhere here. Just do my T account somewhere here. Okay, I just want to do my T account somewhere here. So what is happening here? We have this loan account. I'm going to have loan here, and then we have PTA Bank. Okay, so first thing I need to do is my balance brought down under credit side. It will always be on the credit side, and then how much is my balance brought down here is 1,400,000, which is the balance at the beginning. 1,400,000 rand. So this is the balance that I'm going to have at the beginning, and then on the debit side, what am I going to have there? I have what? The balance carried down, which is 1,004,000. So this side, I'm going to have something like a balance carried down, which is going to be how much? It is going to be 1,004,000 rands. 1,004,000. Okay, we're having how much? 1,004,000 rands. Okay. This is what we have as my balance carried down. Then now I need to go back to the information and see what else do I have there. And I need to get what? I need to get my totals. Okay. Interest capitalized. I also have interest of 168,000. So this side I'm going to have what? Interest expense. Which is 168,000. Since they're saying the interest is capitalized, which means it's already included in this balance, and the payment that I'm going to make this side, there will always be a payment, because now I'm looking for repayments for the financial year, including interest. You see, they didn't give us that, so we need to calculate that. So which means now I'm going to add my credit side and see how much do I get as a total this side. If I add it, I'm getting 1,568,000, and then I'm going to transfer it to this side, 1,568,000. Then now my bank, which means how much I paid will be the difference between the two, and then how much am I getting? It is going to be 564,000 rands. So what is this 564,000? This is the payment that was made, including interest. So then my capital portion, I need to calculate my capital portion, right? Capital portion, how do you calculate it? Is equal to payments made less interest, right? Is equal to payments made less interest. So how much am I going to get? So I'm going to say 564,000 minus 564,000, and then I need to subtract what? 168,000, and then how much am I going to get there? 564 minus 168.
I'm getting 396,000.
396,000 rands. Okay. 396,000, which means this 396,000 is going to be my current portion, right? It is going to be my current portion in this scenario. So what am I going to do now? My current portion of loan, it is going to be 396,000 rands, right? And then I know that this 396,000 is something that I need to go and subtract it from where? From my long-term loan. Can you see that? So which means now for my long-term loan, I can be able to close it now. Then what else am I left with? There's nothing else I'm left with. So I finished all my transaction. So the only thing that we need to do now, we need to close off our, our balance sheet. So I'm gonna transport all the amounts to where they're supposed to be. So this side is going to be 425,000, and then the total here is going to be obviously these two amounts, and then which means this is going to be my total. This is going to be my total asset, which is going to give me 10,377,480, and then I need to close my inventory. I need to close my trade and other receivables, and then get my totals. So for our inventory, how much you're going to get? 1,064,200 minus 40,200.
Um, 1,024,000.
1,024,000 rands. Thank you on that. So let's count this one now. 744,900. Trade and other receivable. How much you getting there?
Um, 867,800.
How much you getting? 867,800 now?
Yeah.
67,800 rands. Okay, thank you on that. And then now, which means now I can get my total. I can get my total here, which is going to be 3,848,020. And then how much will be my total asset? It is going to be my non-current assets plus the current asset, which is end up being 14,255,500, right? And I know very well that my equity, and because retained income, we said we're unable to calculate it. It is going to be our balancing figure. I know very well that my equity and liabilities, I'm still going to have how much? 14,225,500 rands. Now let's close our trade and other payables. How much are we getting there?
$556,150.
556,150, which is going to be my trade and other payables. Then now I'm going to get the total of this. I'm going to get the total of all my trade and other payables, and then how much will that be? 1,452,850. Then my loan, how much will be my loan, the total? How much if we punch our calculator?
$608,000.
608,000 rands. Thank you on that. So that will be our non-current liabilities. Then now, which means now I can be able to get my shareholders' equity, which is going to be my total minus this and minus the loan, right? then I'm getting my 12,164,000. Then, which means my retained income, it is going to be my 12 million minus my 11 million. Then I'm getting 1,013,650, which is definitely this one going to be my balancing figure, because the information that is provided for me, it is not sufficient for me to get the information that I have. It is not sufficient for me to get the retained income. So this is how we do the balance sheet. What I want to teach you, Kinelo, is that you must always try by all means to do everything at once, right? Treat the transaction